Welcome to Subramani. I did one video on investing in alternative assets, and today I'm going to talk to you about the downsides of investing in alternative assets. Alternative assets are definitely good for many people, but it may not be good for everyone, right? Everybody watching this video may not be perfectly suited to go for maybe not even PMS and AIF, which have some visibility, but even worse, private equity and venture capital funding. Do you want to do it at all? Because today it is possible for 10 people to get together and participate in a venture capital fund, right? So you can create it, you can put a manager, you can do all that and run it yourself, right? So all those things are possible. So what are the downsides, or what should you look for? I'm not saying these are downsides. What you should look for, like if you are investing in, say, PPF, right? You opened a PPF account, you know it has a 15-year lock-in, and you know that after 7 years partial withdrawal is possible. All those things you know. With private equity or with alternative investments, if the guy comes and tells you this is for a long term and this is for 7 years, safely double it. Expect to get liquidity in 14 years and not in 7 years, maybe even later. So unless you're sure that you don't require this amount of money for the next 14-15 years, unless you're sure about that, don't invest, right? So looking at the liquidity is very important. Looking at longer horizon is very, very important, right? So you cannot afford to miss that bit and say, oh, I thought in 7 years I'll get the money. In 7 years he will start attempting, and that might take another 2 years, 3 years or 7 years, right? You don't know. So straight away when somebody like this comes and tells you, you in your head double it. So if you don't have a 14-year horizon, don't invest. It's not good for you. The other risk is you don't know whether this person is approaching you as a principal or as a broker. If he's approaching you as a broker, you know that he's going to charge you fees, which could be 1%, it could be 2% plus share of profit, whatever. All that is visible, and you should look at it, because sometimes it can be cruel, saying there's a cap, you cannot get more than 30%. Beyond the cap, we will share 50-50. Any of those things could be there, so be very careful. Read it. It's not like mutual funds where the contract is between you and the AMC, but you know that all of this is captured somewhere and SEBI has seen it, right? So some kind of approval has happened. Here there is no such approval. I'm not even saying SEBI is approving, but I think SEBI scrutiny at least has happened, right? So you do not know how much you're being charged, you do not know how much is the fees, and you do not know how much money he is making as a principal. Perfectly all right for him to make money, but it is not a number which you can ever verify or check or find whether it is reasonable, right? He may have bought it at 10 rupees, he may be selling it to you at 180 rupees, just like the promoter. He may be doing that. But if he is doing that, you will not know that he's bought it at 10 bucks and he's selling it to you at 180 rupees. So now let's look at another scenario. You've invested in 5 years ago in a software company. You bought the share at 180 rupees. You were told it's a great company. It will, in 7 years or 5 years, we will get exit. So it's a superb thing to buy. But then after you bought it, there's nothing great about that company is happening. It has not got a second round of funding. Maybe they don't need it, but or maybe they need it a higher price. So whatever reasons, they have not got a next round of funding. Maybe you entered in the third and now they are not getting the fourth round of funding, and at a appropriate price, right? If you bought it at 180 rupees 5 years ago, you expect that the newcomer will at least pay 350, 360, right? At least in 5 years your money should double, which means you should get at least 13-14% return. That's what you have in your mind. Now you find that some of the other investments by the same manager are doing well, but this one is not doing well. So it is stuck at 180. Let us call this XYZ Limited. Now he comes to you, your manager comes to you, your 5 of you who have invested in this company, saying, look, I don't know what is happening there, but nothing is happening. I can't see anything happening. Now the same promoter wants to buy it back from us at 180 rupees. Should you give it? Sure. Should you not give it? You don't know. Now again, you don't know whether this person is acting as a principal or acting as a broker. That is conflict of interest. So you don't understand. So the other 4 of them say, okay boss, whatever liquidity we wanted, we are getting, so let us get rid of it. So, and it's a deal which all of you have to sign. So reluctantly or happily, whatever, you sign and you get out of it, right? So after you have got out of it, you find next day some Sequoia Capital comes in at 510 rupees. Now, the problem is multifold. You don't know whether your broker himself didn't know. You don't know whether these shares got transferred to the promoter or whether he got it transferred to some friend and he will now sell it in the market at 510. You have no clue about that. You can talk to the promoter. He may or may not agree with you because you're a small guy and your broker is a bigger guy, right? So these are some of the worries that you should have. You do not know whether the deal which is happening behind you is happening at a fair price. Now, if you take a deal in the Bombay Stock Exchange or a National Stock Exchange, there is a back end which is recording it. So you know at 11:29:29 Tata Motors what price. You are not worried about the back end being murky. So in fact, after SEBI came in, our mutual fund success stories are obviously far superior, right? So the original UTI was there, but the new the Canara Bank, Indian Bank mutual funds and all had come, but only after SEBI came, there was better transparency, electronic trading came. Those of you who have seen people going into the ring and shouting, at least in movies you may have seen this, right? So only after the back end was completely transparent did the size of the market grow so much, whereas in private equity, the back end is not so great. Can you get access to their ROC filing? Can you get an access to their income tax filing? ROC filing, yes. Income tax filing, no, right? So once you see all that from a company, then you can make up some decisions. Whereas all that data is not available to you before investing or even after investing, right? Another important thing is all alternative investments are like a limited partnership. You cannot dissolve it, you cannot exit when you want to, when you think, oh, why don't you book some profits and pay some dividend, may or may not happen, you cannot participate. So in a mutual fund also you don't participate, but in the mutual fund, if you're not happy with how the fund manager voted in the AGM, whether he voted for good things, for bad things, voted with the promoter, did not vote with the promoter, when you see those things and form an opinion, you can get out. Here you can't. Remember, this liquidity thing is not just about you getting money when you want it. You will not be able to sell the share when you want it. Sometimes when you see bad governance, there is nothing you can really do. Is there potential for underperformance? Yes, there is huge potential for underperformance. It has happened. I've seen real estate deals doing very badly. Over 5 years, they've lost a lot of money for the client. So bad decisions, or rather bad market timing, is something which everybody, one of us do. You do, I do, and the fund managers also do. So while alternatives have become popular and mainstream, investors should think very carefully, such as about all these factors, right? The time frame and the liquidity and all those kind of things. Will you need access to that money in the near term? Obviously, you should not be touching it. Are you willing to pay higher fees or potentially run into gates which prevent you from exiting? Just think of it. If there's a 7-year lock-in, obviously you cannot get out before 7 years. So think about that. Do you have the wherewithal to manage complex tax reporting, dividends, etc.? Next important thing is, if you are say 50 or 60 years of age and you're very excited about this, is your spouse equally excited? Are your children excited about this, or are they thinking of this as some painful activity? If they will not go out and participate, or they will not chase and participate and come out, this may not be a great investment in your will. Thank you.